Question 10, Moonstar. So this talks about securitization and interest rate swap. We are also going to talk about Islamic finance, the Mudaraba contract, and Sukuk finance. So these are the main themes we are going to cover in these questions. Okay, so let us go through the requirements first. Calculate the amounts in dollar which each of the tranches can expect to receive from the securitization arrangement proposed by non-executive director and discuss how the variability in rental income affects the return from the securitization, right? Most of you, when you read this requirement, you will not be able to understand what they are asking because it's quite complex, right? Securitization and all those things, but it's okay when we go through that, right? We'll understand. So basically the main thing here is about securitization. Okay. Part B, discuss the benefits and risk for Moonstar company associated with the securitization arrangement that a non-executive director has proposed. So you need to talk about the benefits and the risks of this. Part C, discuss the suitability of Sukuk finance to fund the investment, including an assessment of its appeal to potential investors. So you also have to see how appealing the Sukuk finance is for the investor, right? So we have to talk about the suitability of Sukuk finance to investors. The second part under C is discuss whether Mudaraba contract, right, would be an appropriate method of financing the investment and discuss why bank may have concerns about providing finance by this method. Why bank will have concerns for this contract, okay, and how this can be used to finance the investment. Which investment? The investment in the question we are talking about. So now let's read through the requirements first. Go through the case study Moonstar. Moonstar, okay. So Moonstar company is a property development company which is planning to undertake a 200 million commercial property development. Moonstar has had some difficulties over the last few years with some developments not generating the expected returns, and the company has at times struggled to pay its finance cost. As a result, Moonstar's credit rating has been lowered, right, affecting the terms it can obtain from bank finance. Although Moonstar is listed on its local stock exchange, 75% of the share capital is held by members of the family who founded the company. The family members who are shareholders do not wish to subscribe for a right issue. Just see how they are saying. They're talking about different types of finance. First, they told that because of the credit rating is lowered, they're struggling to pay its finance cost. That means debt is not an option, right? Long-term loans and all. Second, now they're talking about family members. Okay, they do not wish to subscribe for a right issue. Why might this be a case? Why they don't want to wish to subscribe for right issue? The reason is they don't want to dilute their ownership, right? It has been given here, and are unwilling to dilute their control over the company by authorizing a new issue of equity shares. So equity is also not an option. So Moonstar company's board is therefore considering other methods of financing the development. Okay, debt is not an option, equity is not an option. They are now looking at other methods of financing this property development. So which the directors believe will generate higher returns than other recent investments, as the country where Moonstar is based appears to be emerging from recession. Okay, so now let's see. We'll go to this proposal, securitization proposal. Because major of the information which you need to write up for securitization, you will get from here. So one of the non-executive directors of Moonstar has proposed that it should raise funds by means of securitization process, transferring the rights to the rental income from the commercial property development to a special purpose vehicle. Okay. Make sure that this is in your part A. Make sure that you study the securitization part before you answer this question, because otherwise you will find it tough to answer this, right? You need to learn about securitization and all. What is it and how to calculate? Okay. So her proposal assumes that the leases will generate an income of 11% per annum to Moonstar over a 10-year period. Okay. So income of 11%. She proposes that Moonstar should use 90% of the value of the investment for a collateralized loan obligation. Okay, which should be structured as follows. So the loan collateralized loan obligation has been structured the only 90% of the value of investment, not the whole 100%. Okay, so now let's see how it has been structured. Okay, We can see 60% of the collateral value to support a tranche of A rated. What is this A rated, B rated, C rated, floating rate and all? Please, it's there in the textbook, go through it, right? So 60% of the collateral value to support a tranche of A-rated floating rate loan notes offering investors LIBOR plus 150 basis points. That's a floating rate. We can see the first one. So it is 60%. Okay, and this is the variable rate. It's a floating rate for A-rated. Second, 15% of collateral value to support a tranche of B-rated fixed rate loan notes offering 12%. So it is 15 and is 12% for B-rated fixed. C is also 15%, which is for T range, and it is fixed at 13%. So lastly, 10% of the collateral value to support a tranche as a subordinated certificate. So 10% is for subordinated certificate with the return being the excess of receipts over payment from the securitization process. With the return being the excess of receipts over payments from the securitization process. So basically this subordinate certificate, you are not given the value, you have to find that is the balancing amount, right? Your return, your excess of your receipt over payment, whatever you get from the securitization process, right? That will be your subordinated certificate. So the balance. Now, the non-executive director believes that there will be sufficient demand for all the tranches. All the tranches means tranche A, tranche B, tranche C. There are different types of tranches, right? And they are given different ratings. Tranche A is the best one. It is the most safest, less risky. Then comes tranche B. Then comes tranche C. Okay. So there will be sufficient demand for all tranches of the loan notes from investors. Investors will expect the income stream from the development to be low risk. Okay. As they will expect the property market to improve with the recession coming to an end and enough potential leases to be attracted by the new development. So they are saying that this will be a low risk, this way of getting income. Why is that? Because property market has a expectation to develop, to improve, because recession is going to end. Whenever recession comes to an end, your property market will improve, right? So they are saying that there will be sufficient demand for all the trenches. That's what they are predicting, non-executive director. He believes. Okay, so the non-executive director predicts that there would be an annual cost of 200,000 in administrating the loan. So there's a 200,000 annual cost. This needs to be taken into account. She acknowledges that there would be an interest rate risk associated with the proposal, right? And proposes a fixed for variable interest rate swap on the A-rated floating rate debt, exchanging LIBOR for 9.5%. That means they are exchanging LIBOR for 9.5%. They are exchanging fixed for variable. Okay, fixed for variable interest rate swap, exchanging LIBOR for 9.5% for A-rated floating rate. Because there's a risk, interest rate risk, what are they doing? They're taking swap. However, the finance director believes that the prediction of the income from the development that the non-executive director has made is over-optimistic. He believes that it is most likely that the total value of the rental income will be 5% lower than the non-executive director has forecasted. 5% lower. Okay, he believes that there is some risk that the returns could be as low as to jeopardize the income from the C-rated fixed rate loan note holders. So he is believing that there's a risk that returns can go to that low, right? Now we'll go to the Islamic finance, right? Islamic finance we'll read later. First, based on the case study we have read till now, we can answer part A and part B, right? It is about securitization. So securitization part A will read again. The requirement says calculate the amount in dollar which each of the tranches can expect to receive from the securitization arrangement. So all the tranches, under each tranches, how much you're going to receive, right? Proposed by the non-executive director and discuss how the variability in rental income affects the return from the securitization. First, you have to talk about based on the non-executive director's proposal, and then you need to talk about the risk. What if it's 5% lower and all, right? And second, we need to talk about benefits and risk of securitization process to Moonstar, which is for 6 marks. So when you come here, let us, okay, before we go through the case study marking scheme, we'll go through the answer. Okay, this is the way you have to calculate part A. So an annual cash flow account compares the estimated cash flow receivable from the property against the liabilities within the securitization process. The swap introduces leverages into the arrangement. So this how it will be like a T account you have to create for securitization whenever you are given different tranches. Okay, on the right side, on the left side, you have to put all your cash flow receivable and all because it's an asset. So cash flow receivable will come on the left side, right? You have to deduct your service charge. Then on the left side, right side, all your liabilities will come, right? A rated loan notes, B rated loan notes, C rated loan notes, and also subordinated certificate, which is the balance. You see, these are cash flow payable. So first we'll calculate, start from the left side, which is cash flow receivable. How are we getting cash flow receivable? We have been told that from the property development, we are going to undertake a 200 million commercial property development. So that 200 into what is the income? The lease will generate an income of 11% per annum. So 11% into 200. And also we have been told that there's annual cost of 200,000 in administrating the loan. So that, right? So this is in million. Please check. Okay, so 200 into 11%, it is 22 million. From this, you have to deduct your service charge, which is 200,000. So 200,000 means 0.2 million, right? And you're getting 21.8 here. Next, we'll go to the each transaction. And if you see each transaction has workings, right? You need to go through the workings first, A, B, and C. How are we going to do the workings? Here it is 200, right? For each. Out of this, 90% only. We have been told that 90% has been used. And for here, it was 60% for A, 15% for B, and 15% for C, right? And you're getting this 108, 27, 27, right? That is also perfect. We can see that it is 108, 27, and 27. And this percentages has been given to you, 12 and 13. It is fixed. But this percentage, this 11 percentage needs to be worked out. For that, there's a working 2. Now let's go to working 2. That is swap, right? So they told that you are going to swap fixed for LIBOR. That means you have to pay fixed and you're receiving LIBOR, right? Before your floating rate was this, right? Your LIBOR is this, LIBOR plus 1.5%. Now you are going to pay 9.5% fixed and you have to receive LIBOR. That's why it's deduction. So LIBOR gets cancelled. 9.5 plus 1.5 is 11% because you are exchanging variable for fixed. So net payment is now 11%. That's why you are taking 11% here for A rated. Once you calculate, you are saying that there's a balance. 21.8 minus 18.63, you are getting this 3.17. And that balance goes to subordinated certificates. It will come on the right side. Okay. So now we'll see what has been given here. You have to write it in sentence. Okay. The holders of the certificates expected to receive 3.17 million on 18 million. Why on 18 million? How they got 18 million? How did they get 18 million? How did they get 18 million here? Because it was for just check, right? $200 million, right? So out of that 200 million, you have to take 90%, right? You have to take 200, 90% on that. right? You'll be getting 18 because 90% only will be used. So out of that 18 million, out of that 18 million, wait, so here it is. On that 3.17, that means if you take 3.17 over 18 million, it will have a return of 17.6%, right? That means if the cash flows are now, if the cash flows are 5% lower than the non-executive debt as predicted, annual revenue received will fall to 20.90 million. How is that? Look at the annual. It is now 22 million, right? Just deduct it by 5%. 22 multiply by 0.95 because it will fall by 5%. So it will be 20.9 million now, the annual revenue. Reducing the balance available for the subordinate certificates. Now, if you, with this annual revenue, you take and calculate the balance, you will get this subordinated certificate. Now, you saw that it fell from 3.17 to 2.07, giving a return of 11.5% on the subordinated certificate, which is below the return offered on B and C loan notes. Just see 11.5%, whereas the return here is 12% and 13% here. It is even less, that 11.5 is even less than B and C's rate, right? How 11.5%? Because 2.07 divided by what? Divide by 18 million, right? 2.07 divided by 18 million. You will get 11.5%. The point at which the holders of the certificate will receive nothing, and below which the holders of the C-rated loans will not receive their full income, will be an annual income of 18.83, a return of 9.4%. 18.83. Why is that? Just check here. If you see this side, it is 18.63. So here, if it's 18.83, 18.83 minus 0.2 will be 18.63. So here also it is 18.63. Here also the total is 18.63. Right. How will you get this balance? Right. There will be no balance. It will be 0. So you cannot have any subordinated certificate. Right. So what happens due to that? A return of 9.4%. A return of 9.4%. How are they getting 9.4%? That's it. That is 18 point, right? 18.83 divided by 200. Out of this 200, 18.83 is annual income. So it's a 9.4% return, right? If you see that the return has fall down from what? 11.5. I'm sorry, 17.6, right? Just check the return now. It is 11% here. Now it is 9.4. It fell down. So before they told that there will be a 5% reduction, right? Cash flow will be 5% lower. So with that 5% and this 9.4%, total is 14.4%. So they are saying which is 14.4% less than the income that the non-executive data has focused, right? This is a little tricky, right? This type of question. So you need some time to settle down and get observed, right? You need to observe this question. You have to read it maybe many times before you are able to understand this and attempt this. Do it, right? Once if you don't understand, try it second time, third time, fourth time. The more you do, the better you will understand this question, right? This was not that type of question like risk management or acquisition and merger, which is very easy to understand and which is fixed, right? This You need to be more aware of this. Where are you at the moment, and what are you calculating, and what are you doing, right? So now let's go to the benefit of securitization. So these are some of the benefits. Even when you have to write about securitization, you can pick the points from here. So I'll be going fast from here onwards because we don't have any calculation part. So the finance cost of the securitization may be lower than the finance cost of ordinary loan capital. Okay, the cash flows from the commercial property development may be regarded as a lower risk. So one is lower finance cost. Okay, second is lower risk. Okay, the benefit of securitization. Then Moonstar's other revenue streams. This will impact upon the rates that Moonstar company is able to offer borrowers. The securitization matches the assets of the future cash flows to the liabilities to the loan note holders. Okay, so it matches assets and liabilities. The non-executive director is assuming a steady stream of lease income over the next 10 years, with the development probably being close to being fully occupied over that period. Okay, the securitization means that Moonstar is no longer concerned with the risk. No longer concerned with the risk. Okay, with securitization. Risks that the level of the earnings from the properties will be insufficient to pay the finance cost, right? They don't have to be worried about that risk, whether they are getting enough earnings from the property, right? Or whether their earnings which they are getting is insufficient to pay the finance cost. But in if you are taking loan and all, you will be in a trouble. You have to worry about whether you are able to pay your interest or not on time and all those things. So what happened in securitization was risk have effectively been transferred to the loan holder. So risk is transferred to loan note holders. That's what happened in securitization. Now let's go to the risk. Not all the tranches may appeal to investors. They should know not all may appeal to investors. Not all A, B, and C. The risk return relationship on the subordinated certificate does not look very appealing. Yes, the risk return does not look appealing on subordinated certificate. Why is that? Return is very low, right? We saw that with the return quite likely to be below what is received on the C-rated loan notes. When we saw that return, okay, we'll go up and see the return. What was the return? The return, if you see here, after that 5% decline in cash flow, 11.5%. Whereas if you see here, it is even below B and C. B is 12%, C is 13%. So it will not be attractive, right? That it will not be appealing. Even the C-rated loan note holders may question the relationship between risk and return if there's a continued uncertainty in the property sector. Okay. If most company seeks funding from other sources for other developments, transferring out a lower risk income stream means then the residual income. That means if you are transferring out, if you are having an income stream which is of a lower risk, if you are transferring that out of your business, what happens is that the risk remained, the residual risk associated with the rest of the Moonstar's portfolio will be higher. So this is a risk, right? This may affect the availability and terms of the other borrowing. It appears that the size of the securitization should be large enough for the cost to be bearable. However, Moonstar may face unforeseen cost, possibly unexpected management or legal expenses. Now let's go to C. C. Before we attempt C, we need to go through Islamic finance part. We didn't read it. So Moonstar's chief executive has wondered whether Sukuk finance would be a better way of funding the development than securitization. Moonstar's chairman has pointed out that a major bank in the country where Moonstar is located has begun to offer a range of Islamic financial products. The chairman has suggested that a mudaraba contract would be more appropriate method of providing funds required for the investment. So you have to talk about mudaraba and sukuk finance, the suitability and how it is appealing and all, and why the bank may concerned. Okay, so let's go to part C, which talks about sukuk finance. Make sure that you know something about sukuk finance, because this is a question. If you are asked from Islamic finance, you might be asked on about sukuk finance. It is like sukuk is kind of like a lease. Okay. So sukuk finance could be appropriate for the securitization of the leasing portfolio. Okay. And asset backed. We all know that there are two types of sukuk. One is asset backed, one is asset based. And you need to know the difference. The one which is supported in Islamic finance in sukuk is asset backed. That's why we talked about asset backed in that first paragraph. Okay, and asset backed sukuk would be the same kind of arrangement as securitization, right? So asset-backed sukuk is same as securitization, where assets are transferred to a special purpose vehicle and the returns and the repayments are directly financed by the income from the assets. So the sukuk holder would bear the risk and the returns of the relationship. Okay. And what is the other type of the sukuk they are talking about is it is more like a sale and a leaseback of the development. Here the sukuk holders would be guaranteed a rental. So it would be seem less appropriate for Moonstar if there's significant uncertainty about the returns from the development. If Moonstar has this uncertainty that are they going to receive that rental income or not from the development, then this they will not support, right? This type of sukuk. So now the main issue with the asset-backed sukuk finance is whether it would be as appealing as certainly the A tranche of the securitization arrangement, which the non-executive directors proposed. The safer income that the securitization offers a tranche investor may be more appealing to investors than a marginally better return from the sukuk, right? So there will also be cost involved in establishing and gaining approval for the sukuk, although this cost may be less than for the securitization arrangement described above. So this is how you need to talk about the advantages and disadvantages of both sukuk and securitization, and need to talk like this, right? On the other hand, you are saying advantage, again you have to talk about disadvantage, right? So the advantage of sukuk is what? Even though it is less costly, but the disadvantage is that it, right? There will be cost involved in gaining approval and establishing for sukuk because a tranche, right? A tranche is giving you a safer income. So investors will be more appealing for that. There will be more appeal towards that a tranche rather than the sukuk. Now you need to talk about the mudraba contract, how this can be used to finance the investment, and why the bank, what are the concerns of the bank, whether they will give this finance or not. So a mudraba contract would involve the bank providing capital for the Moonstar to invest in the developments, right? I'm just not reading this for the sake of reading it. When I'm reading the sentences, what I meant is I want you to understand. Through this, you understand what mudraba contract is. It is like bank is providing capital to the company. Okay. So Moonstar would manage the investment which the capital funded. So who is managing the investment? It is the company, not the bank. Bank is only providing capital, only finance. So what happens when profit comes? What happens when losses comes? Okay, so let's see. Profits from the investment should be shared with the bank, but losses would be sold only by the bank. This you have to know. These are the features of Mudraba contract. So when I'm reading, I'm just not reading it, I'm learning. I'm learning about more and more about Mudraba contract. So this is how you learn through your revision kit. Not just writing and copy pasting answers and keeping my answers as it is. I'm understanding what Mudraba contract is. So what I understood in short is bank is providing capital, but company is running it. If it's a profit, it's equal. If it's loss, only bank is bearing the loss. Okay. So a Mudraba contract is essentially an equity partnership. So it's an equity partnership. So Moonstar might not face a threat to its credit ratings, which it would be if it obtained ordinary loan finance for the development. We saw in the beginning of the paragraph that it was having a low credit rating, right? But here in this case, this will not affect its credit rating, this way of contract, the Mudraba contract. But if a loan has been taken, yes, ordinary loan finance, not Mudraba contract. If an ordinary loan finance is there, yes, it can affect the credit rating of Moonstar. So a Mudraba contract would also represent a diversification of sources of finance. It would not require the commitment to pay interest, then that loan finance would involve. See, another advantage of Mudraba contract is you don't have to pay interest. Even though the bank is the one who's providing you the capital, it's like you're taking a loan from the bank, but you're not paying any interest to the bank. If you would have taken a loan finance, yes, you would have to pay, but not in Mudraba contract. So you see how I'm learning the advantages and disadvantages and the features of Mudraba contract slowly. Next, Moonstar would maintain a control over the running of the project. Who is maintaining the control over the project? That's the company, Moonstar. A Mudraba contract would offer a method of obtaining equity funding without dilution of control with an issue of shares to external shareholders would bring. We saw early that the shareholders, the family shareholders in Moonstar, they don't want to go for right issue. Why? Because they don't want to dilute their ownership. But if you go for a Mudraba contract, even though it's an equity partnership, the good thing about it is there is no dilution of ownership, no dilution of control. Right? But if you go for an issue of share to their external shareholders, then it will bring dilution. But here, it will not bring. You are obtaining equity also, but there's no dilution of control. So this is likely to make it appealing to Moonstar's directors. Of course, you are not losing your control. You are getting equity also. Which director will not like this offer? So you can say that this is appealing to Moonstar's directors given their desire to maintain a dominant influence over the business, because they want to influence their family business, their family who have been there in the shareholders. So they want to maintain that dominant influence over the business. For them, this is an interesting, appealing proposal, you can say. Now we'll see the last paragraph. The requirement also asked what are the concerns of the bank of providing this Mudraba contract. So we'll see from the bank's point of view. The bank would be concerned about the uncertainties regarding the rental income from the development. Although the lack of involvement by the bank might appeal to the Moonstar's directors. See, Moonstar's directors are happy that the bank is not being involved in running of the business. For them, it is appealing for the director. But what about the bank? Bank might not find it so attractive. There's a risk to the bank. When it's a loss, bank is the one who has to suffer. So the bank might be concerned about information asymmetry. That Moonstar's management might be reluctant to supply the bank with the information it needs to judge how well its investment is performing. Right? Moonstar does not want to supply that much information to the bank about how their investment is performing well or not. But bank, on the other hand, they might need such information to judge, to assess how well their investment is performing or not, because they are the one who is providing capital, right? So there's an information asymmetry. So this, because of that uncertainties of rental income and information asymmetry, these two reasons, for bank it might be a concern. They might not be so happy with this proposal. It might not be appealing to the bank. Whereas on the other hand, if you see the Moonstar's company's directors, they are happy, right? Because if it's a loss, bank is suffering. And also bank is not interfering in the operation of the company. It is how you manage, how you run the company is totally with the company. And also there will be no dilution of control of the company. Bank is not going to take control of the company. It is with Moonstar only. So these are some of the features of Mudraba contract. So by the end of this video, I want to say the note is you should know what is Mudraba contract. You should know what is Sukuk finance, right? Learn about asset backed, asset based Sukuk finance, the differences and all. Securitization, different tranches, how it is, how it works, right? And the risk and the benefits of securitization and all those things. Now we'll go to the marking scheme. Right, this is the marking scheme. If you see calculation of receivable, that 11% into 200, 1 mark. Loan note amount for A, B and C. Impact of swap, you need to show that swap. Okay, calculation of interest payable on interest for tranches A, B and C. Estimation of return to subordinated, the subordinated certificate, that balancing amount you need to calculate. And also you need to comment on calculation related to sensitivity, right? That 5% decline and all those things you need to talk about. Then we have benefits and risk with securitization 3 to 4 and 2 to 3. Next, we have Sukuk finance, how suitable Sukuk finance is, and discussion from the investor's view. Here the discussion is from the bank's view and also suitability of Mudraba contract. Right? And please go through this question, this type of question 2, 3, 4 times. So until you know the format and you know that when this type of question comes, what do you have to do, how to calculate the interest rate, right? So that's it for this video. Hope you like this video, and don't forget to share this video with your friends, among your friends, right? Because I know all of you are struggling with this topic. So that's it, and best of luck with your AFM, and do subscribe to this channel and share my video and share my channel with your friends, and do tell them to subscribe to this channel so that they get benefit. And take care. And the thing which I forgot to tell, how this 18 million came was, okay, so the total is 200. Out of this only 90%, right? And from this, which is 180, you have to take 10%, which is 18 million. Why 10%? Because just see here, the last one, it says 10% of the collected value to support a tranche supported subordinated certificates, right? So that's why we are taking 10%, right? We are taking 90% on this 200, and then on that we are taking 10%, which is 18 million. So out of this 18 million, we saw that 3.17 is for subordinate certificate, which is having 17.6% return. So that's how you get 18 million.